After Hours show brought to you by Ticker Time News. I'm Adam, and we have a lot to discuss today. We are going to go over a quick market recap, and then we're going to dive into a little bit of Bitcoin, and we're going to dive into the bonds market and take a look at what's happening there. And then lastly, we're going to look at FedEx and their amazing earnings report today that came out. But before I do go into any of that, remember this show is for you. Just leave a ticker symbol of any company you would like to dive into in the comment section, and we will go over that company live on the show. We'll look at chart patterns, price action for the day, support and resistance lines. I know the market was falling today, and knowing where those lines are can come in handy for you. So again, support and resistance line, any chart patterns that may be forming due to the stock volatility that's happening lately, and any top news for that company. So just leave the ticker symbol in the comments, and we will go over it live on the show. And if you are happening to catch the show after the live stream, you can still leave a comment in with the ticker symbol, and we will start the next show with those ticker symbols. So thank you all for joining us. Thank you for being here. And without waiting any longer, let's dive into this messy market that we have today. Let me just share my screen with you real quick. All right. So up first, the market just fell apart today. Yesterday, we got news from the Fed chairman about rates and how they were going to stay between 0 and 0.25% until the year 2023. Well, I think some people heard interest rates low, and then all of a sudden they see that interest rates spike today up to 1.72% at one point and got a little nervous and sold out of some of their positions. So Wall Street did close in the red today, as we just saw, and we'll go over the indices in just a moment. But it closed in the red because yields continued to rise following the Fed's decision yesterday. The 10-year Treasury, as I mentioned, reached a 1.72%, which is over a 1-year high, triggering a sell-off mainly in tech stocks, but mostly all around, as we'll also see when we look at the heat map for the S&P 500. On the macro side, initial jobless claims surprisingly jumped to a 1-month high of 770,000. Meanwhile, the WTI oil prices tanked 8.4% during the session to 59.17 per barrel and suffered the worst day since September of last year as demand concerns and uncertainty over vaccination rollouts dented confidence. The Dow lost 153 points or 0.5%. The S&P 500 retreated 59 points or 1.5%, and the Nasdaq plunged 409 points to 3%. As we can see here that the Dow did close down 0.47%, excuse me, 0.46% to 32,862. S&P 500 down 1.4% to 3915, and the Nasdaq down 3.02% to 13,116. Bitcoin, it actually has gone up. There was a huge spike in Bitcoin. Bitcoin currently right now is holding up 0.25% at 57,673. Ethereum is still down from its highs at 1,493. If we hop over here and look at Bitcoin, which is a ticker symbol BTC, and then slash USD for the US dollar. Uh, Hold on. There we go. All right, as it loads there. So, Bitcoin today. This is what it looked like. This is the 1 hour chart. And you can see over here in this area, and let me just draw that out for you so you can see too. Right here in this area, Bitcoin spiked to a high of 61,781, and that was about around noon to 3 o'clock this afternoon, somewhere around that time, depending on your time zone. So it did spike to that point, and then it sold off down to this low. And let me put a circle on here for that right here. And the low got to 53,570. And then the Bitcoin rose back up again, reaching a high of 60,083. And now it's back down and it's staying around this kind of comfort zone between 57,000 down to 56,000. That seems to be the consolidation point for Bitcoin right now. So that's what it did. It hit those points today. Let's go ahead and clear this chart of those circles we just made. Hang on one quick second. Okay, so that's what happened to Bitcoin. So over the past 24 hours, it did hit $60,000. Okay, there is a new poll out by Harris that shows 1 in 10 Americans will use their stimulus checks to buy Bitcoin and Ethereum. So over the next week or so, when the checks start reaching the majority of Americans who are going to be eligible to receive the $1,400 check. 1 in 10, putting that into Bitcoin and Ethereum, that is definitely going to cause volatility and the price to rise some. So in the poll, the numbers were quite staggering. There was another poll that they cited. Um, where is that one here? Uh, let's see. Was it right here? Yeah, right here. In Japan, they took a study 3 days ago, and they polled 235 individuals who make less than $150,000 annually. The survey respondents had shown that 40 billion out of the 360 billion in direct stimulus would go towards Bitcoin and stocks. 24 billion out of the aggregate, or 60%, would possibly flow into Bitcoin, that survey noted. So there's a lot of money about ready to hit the market. Now, with that being said, there's going to be a lot of uncertainty and a lot of pain and volatility in the market over the next 3 months. So buckle in for that. As the world's economies start to open back up, as more vaccines go out and more companies start to open, rehire, and e-commerce starts to maybe tick down just a little bit as retail, brick and mortar stores start to open back up and start to see more foot traffic. It, the economy is going to have to catch its footing over the next 3 months or so to find out where we're going to be in our new normal. Are we going to go back to the way things were before the pandemic started over a year ago? Probably not. It's going to be a new normal, and we're going to have to find our footing and figure out where that is. So that's why I feel over the next 3 months, we're going to have a bit of volatility and uncertainty, even though it seems like there's going to be quite a bit of money pouring into Bitcoin, cryptocurrencies, and the stock market and other equities. So that's something just to keep in the back of your mind. Now, on the S&P 500 sector breakdown, you can see today there was a lot of red, and it really didn't hit until this afternoon. It really sunk off. The only 2 areas of brightness that I can see on the chart is the financial sector, specifically banks that are diversified. Maybe a second runner up to that could be in the healthcare industry, specifically healthcare plans, the subsector. And maybe in third place for today is banks, but they're regional banks, so smaller banks. That's the only real spots of green that you can find on the chart today. If we dive into the bubble portion of this, let's just close this ad out. As it loads, you can see yesterday when we looked at this bubble map, it was up here around, let's get rid of the ad. The main bubbles, you can kinda see they're grouped together on this line that's just between the 0% and -5%. This bubble line was up by the 10% line, up here in this area yesterday, um, between the 5 and 10%, this area here. So, the whole entire market, you can see that it has slumped. We've got one crazy bubble way up here. The Hartford Financial Services Group was up 18.7% today. That's the only real bright spot that's on the map. A very, very rare occurrence here for our map today. So you can see that Amazon down 3.4%, Alphabet down 2.6%, Tesla down 6.9%. There's another big bubble. We got Chevron down 3.6%, another big bubble. Visa down 1.06%. Johnson and Johnson down 0.19%. We got Apple down 3.39%, and we've got Microsoft down 2.67%. So that's some of the action there happening today. Now, FedEx reported amazing earnings today. The Q3, and this is for their, fiscal year Q3, EPS of $3.47, and that would beat the estimate by 23 cents. Revenue came in at 21.5 billion, up 22.9% year over year, and that beat estimates by 1.56 billion. For the fiscal 2021, for the entire full year, FedEx is forecasting only this small snippet for earnings of 16.80 to 17.40 per share, and that's all they are forecasting. They are not forecasting any other estimates for the full year of 2021 because they're a bit uncertain of how the delivery of the vaccines is going to play out over the long haul this year and how that may affect their business, as well as what is the shift from e-commerce to brick and mortar stores. How is that going to affect their business? They're unsure about those two main key areas. All right, let me just hop over here real quick just to check it out. All right, we're looking good. Okay, so two things I want to go over. The first one is the 10-year bond yield, and we can look that up on the chart. Its quote ticker symbol would be US10Y as a ticker symbol to look it up on the chart. This is the US government bonds 10-year yield. And what I wanted to point out on here, I'm going to go to the daily view on the chart. And when I shrink it in, we're going to get perspective. That's the exercise that we're running right now, perspective. So we can see where we are currently, where we've been, and what it looks like maybe going forward. There's two paths. So if we go back all the way back several years ago, if we go all the way back right here to June of 2007, all the way back to June 2007, we can see very clearly that the 10-year yield was at 5.306. That's where it was. We are currently at 1.715. So we are a long ways from where the bond yield was in June of 2007. And you can see from 2007 all the way down to uh, the 2012s, July of 2012, it dropped from the 5.3% down to 1.38%. And then from there, it rose up to on from the middle of the year of 2012 up to the end of the year, December of 2012, to 3.04%. And then from 2013 down to 2016, it dropped from the 3.04% to 1.376%. And then from the middle of the year to the end of the year, it rose from the 1.38% up to the 2.64%, as you can see right here. So you can see that pattern. Um, this was over the course of the year, middle of the year to end of the year of the following year. So a year and a half, it went up 1.3 to 3.0. And then for several years, it dropped down to the 1.37. And then in half of the year, it rose to 2.6. And then we go from 2016 down to September of 2017, and we lost 0.6%. And then from September of 2017 to October of 2018, so 13 months, it went up from 2.0 to 3.2%. And then we were on a big drop down from October of 2018 to March of 2020. We went from 3.25 to 0.54 points. That's where it was last March. Now, here's two very important things to keep in mind. Let's look at these peaks. 3.25, we have a peak of 3.03, and then we have to go all the way back to '07 to get a peak of 5.3. So we are nowhere near those peaks right now. Could we get there? It is possible. However, I think it's unlikely that we're going to go up to 5%. Extremely unlikely for 5%. Now, look here on the chart. From March, and let's open this up a little bit to make it a little easier to see right here. Okay, this is still daily candlesticks, all right? So from March 2020, 0.54%. And then we follow this nice, almost flat line, ticking up just a little bit. And then we get here August of 2020, and we've gone from um, 0.54, and we're still at 0.54. Even though we had this spike, it came right back down. Now, from last August until the 1st of February this year, we were on this nice, steady, but slow incline. You can see it on this line right here. But then, the beginning of February, something happened. This angle of this angle right here, it changed and it started to move up at a much faster rate. And that's why we are in the 1.7s right now instead of maybe a 1.1 or a 1.2. If this bottom trend line right here, and let's just mark that out so we're clear what we're talking about. If this trend line right here, this is option A, and it could go, and we'll put A right here. It could go along this path right here, a climb up until we reach some kind of a top. Or we could take option B, which is going to be over here. Option B. And it could go this way and take this path. Now, which path would you choose? Option A, path A. That's where I would rather go. But right here, we had a divergence. Let me mark this in red because this was a big changing area right here. This right here is what has caused the volatility in the stock market over the past few weeks since the 1st of February. Now, are we going to continue on this path? Well, the Fed says no, but the yield rate has gone up. So, this is where we are right now. If we continue on this path right here, we may get up to a maybe 2.5, maybe even up to a 3%. And on the chart, let's bring perspective back in. If we get up to a 3%, that's going to put us right about right here in that oval. If we get up to a 2.5%, oh, that's about right here. All right. So 2.5%, 3%. We could get into this area. That is very possible over the next 3 months. After we get past summertime, we should have our footing back. And once we get our footing and we start to get back in stride, and that machine starts to crank, and those pistons start to fire, or if we're on an electric engine, then it's going to move a little different than that. But we will be more stabilized once we have got our footing and our stride starts to come back. And I'm referring to the economy, of course. So until we get that stride back, we could be on path B for the next 3 months, give or take a few days or a few weeks. And then we might end up more on like a path where we were in 2016 to 2017, where nice slope down. Or we could be on a path like we were in August of 2019 through December of 2019, where it was a nice steady rise. It wasn't going up in dramatic effect like it did starting in the beginning of February. So this is something to keep in mind. Path A is where we were from August of last year to the 1st of February of this year. But then the 1st of February, we took a divergence from path A and we chose path B. So just something perspective on the 10-year yield in the bond market is since it seems to have this correlation to the stock market. And if you look down here at the RSI or the MACD, you notice whenever we pop out of the box, out of the top of the relative strength index box, or we pop up like this on the MACD over a one over a point 0.1 percent there, you notice that it does fall back down. So maybe we've reached a peak for this moment in time. Maybe tomorrow Maybe things go down a little bit. Maybe it goes up to 1.8. We don't know. So, just something to keep an eye on right here. It's a good way to get perspective on where we've been in history, where we might go in the future, where we are right now. All right, let me just check over here for just a moment. All right, now we're going to look at FedEx. FedEx had an amazing, I mean, amazing quarter. Their 2nd quarter, the last quarter when they came out in December, they had a stellar quarter, but their stock did not react in a positive way. It actually went negative. And the reason it did that is because there was no guidance for the 3rd quarter. They didn't know what was gonna happen, so they didn't release guidance. Similar, not exactly the same, but similar to what they are doing now. They have this strong, big, massive, excellent quarter, but then they give just a little tiny peek at what guidance is for fiscal year 2021. So let's get into the numbers real quick. That's what is most important, and then we'll hop over to the stock chart for FedEx. So first off, revenue of 21.5 billion. Operating income at 1.06 billion, operating margin 4.9%, net income $939 million dollars, and earnings per share or EPS of $3.47. Yes, FedEx is kicking it. They are running on all cylinders right now. Here's what their CEO had to say, Fred Smith of FedEx. I'm exceedingly proud of our FedEx team members who are moving the world forward through the delivery of COVID-19 vaccines, the most important work in the history of FedEx. He went on to say, as reflected in this quarter's results, continued execution of our strategies is producing strong earnings growth and margin improvement across our company. We expect demand for our unmatched e-commerce and international express solutions to remain very high for the foreseeable future. That is excellent for FedEx. So, operating results increased primarily due to strong volume growth in U.S. domestic residential package and FedEx International Priority Services and pricing initiatives across all transportation segments. These factors were partly offset by costs to support strong demand and expand services, variable compensation expense, higher labor rates, and one fewer operating weekday. So FedEx, they're just doing an amazing job, and I see FedEx continuing to do an amazing job. The amount of growth cannot be overstated in the residential package portion of their business. UPS and the USPS and any other delivery company has been facing this challenge of exponential residential growth in package deliveries, all because of, well, you guessed it, COVID-19. So they also mention in here that severe winter weather during February reduced the quarter's operating income by an estimated $350 million. So just think, if we didn't have that bad stretch of winter weather, they would have made an extra $350 million to what is an already outstanding earnings report. So they also say the weather significantly impaired operations at several of the company's largest facilities, including the primary FedEx Express hub in Memphis and FedEx Express hubs in Indianapolis and North Texas. Net income reduced tax benefits of $108 million or 40 cents per diluted share from a tax rate increase in the Netherlands applied to deferred tax balances and associated with voluntary contributions to the company's pension plans. Now, their outlook FedEx, and this is what they say FedEx is unable to forecast the fiscal 2021 year end. So they're not sure where they're going to end up this year. And they cite the delivery of vaccines and the possible divergence from e commerce to brick and mortar. Possible. What they do say as forecast earnings of $17.60 to $18.20 per share on the year, and that's all that they give us. Now, um, again, an amazing quarter for FedEx. They are making it, they are pushing results, and they are winning. So let's hop over to the chart here and see what we can find out. Ticker symbol for FedEx is FDX. Okay. All right, let's open this up just a little bit so we can see from uh, the March lows, which is over here, March 13 to March 18 is where they hit their bottom of 2020. They were kind of flat from there until June of 2020, and then they were on a very nice ascending trend line here, and a very nice. Once you got to August, they were almost in a perfect ascending trading channel, all the way up to their peak in October, and then they sold off a little bit, but then they went on a rally and they got to their all-time high at the beginning of December and then sold off through the 1st of January. And that's where we can find now some consolidation, maybe a little bit of growth. We'll switch it from the daily chart to the hourly chart to find out where we are right now. And again, we're just going back to the beginning of the year, January 1st, right there. So, right here, where you see the blue part on the left side of the screen, where this bottoms out is on January the 8th of 2021. And that's where you can see this consolidation pattern. We get up to this purple line, and the reason it's purple is because it's a very flimsy resistance line. It can act as support sometimes, it can act as resistance, and as a matter of fact, this line right here should not be red. This line should be blue or green because it's acting as support. So we had, we have, we have and had good support at $240. Excellent support down there if it does fall that far. We also have this support slash resistance. It varies from time to time at around $260. You can see that it played around there for a long time, starting February 9th of this year, all the way until about March the 10th. And then it started going for a rally. So we could plot out here of something a little bit different since we just got the results from their quarter. And then I want to, after I do this, I want to talk about their dividend because there's something that could be happening there with that dividend. Okay, so we can actually draw a box right about here for FedEx. This is at $269. And I'm gonna take it all the way back to September of last year. So from $269 and we'll run it up for to $274, right about there. Okay. This area right here is a good area to watch. You can see recently, March the 12th, and today, March the 18th, it acted as resistance. Then we got the news about their earnings, and then we shot up to right about the top of this box. And the reason this box is significant, if we go back here, December of 2020, it acted as support several days in a row right here. And if we go back any further to November, the 1st of November, it acted as support for several days right here. And then almost the entire month of October, it acted as support as well. And then back here, this is the end of September, beginning of October, it acted as support. So if FedEx can get above this and maintain support here, then it can go higher to our resistance line, which is going to push it to the $280 to $290 area per share there. So if you're looking at FedEx and want to get in, I think your buying opportunity is really around $260 if you can get it for that amount. Um, Set a stock alert, 260. Remember, the next 3 months, even with a solid performing company, the market as a whole can drag the stock down. The next 3 months are going to be volatile as the economy finds its footing. So set a stock alert for 260. If you can get it there, that's a good area. You can set a secondary stock alert if you want to dollar cost average your way down if you don't think it has reached its bottom at 260. You can set it for about $245. That also has really good support. That line here, I can put it because I'm just going to put a line there for that. $240. Really, it's $245. It's right here. 245. That would be a excellent um, stock alert right there. $245. Set one there. And then you can set one for $260. Those would be the two areas to buy in to FedEx for a long position, not a short one because there's going to be a lot of volatility over the next 3 months. Okay, let's hop over here real quick just to check it out. Okay. Well, I believe that is going to wrap it up for today. I've got everything in that I wanted to, plus a little extra for you guys. FedEx earnings did really good. We got a new poll from Harris saying 1 in 10 Americans are going to use their stimulus to buy Bitcoin, Ethereum, cryptocurrencies, and stocks. So we're going to have money being pumped in to the system, but we're also going to be on shaky footing over the next 3 months as the economy tries to find its way back to a new normal. So, a lot of volatility. Expect that. You can expect all time highs and you can expect pretty dramatic pullbacks of 10, 20%, maybe 25% sometime over the next 3 months. So just keep your eye out for that. Look for buying opportunities. You know the saying, buy the dip. That's why you set stock alerts and you don't have to look at the stocks every single day and monitor it every single minute. Set stock alerts, saves you a ton of time. And then when you do that, you don't miss out on a good buying opportunity. especially for a strong company. Okay, just a couple more reminders. If you're watching this show after it has aired live, you can leave the ticker symbol of the company you want to look at in the comments, and we will go over that company in the next episode. So you never miss out. This show is for you, the viewer. Leave a ticker symbol in the comment and we will go over it. Okay, you can help us out by smashing the like button, clicking subscribe, join our family of investors. We put out content daily. You can also help us and support our work on Patreon by becoming a member. And just leaving a comment, letting us know how we're doing also helps out greatly. So, with that said, have a wonderful evening, and I will see you tomorrow after the markets have closed. Have a good night.